Hello everybody. Today we have speech 3. We're going to be talking about investing in mutual funds. Now, when I think about investing, I recall in the crisis of 2008 when, obviously there was a global recession, the worst one that we've had in over 80 years. And I thought to myself, why is it that, am I doing the right thing as far as keeping my money in mutual funds, or should I look into do a little bit more research and maybe invest elsewhere? So that's sort of what we're going to be looking at today, because I couldn't help but thinking during the recession whether or not a lot of people lost a lot of money, right? And a lot of people thought, well, maybe they should be doing it differently, or maybe I should be doing it a little more secure, finding something with possibly less return, but at the same time more secure, right? But what you're going to see today is that when you're investing over a long period of time, recessions, thanks to dollar cost averaging, might actually help you, because you actually buy a larger amount of shares when stocks are down. So we're going to go straight into it. And these are the different types of mutual funds that you can actually invest in. You have money market funds, which are usually U.S. government, very high quality and very secure. Then you have bond funds, which are slightly higher risk, and there's different types, which I won't go into because we really don't have the time today. And then there's stock funds, which are usually like your S&P 500 international companies. But then we also have nowadays what's called target date funds. And these life cycle funds, that's what I actually recommend and what I actually have now, which is over a long period of time. You have, say, for example, the G fund, which is the government fund. And in this piece of the pie, your investment is a smaller portion, because right now, since I'm young, I can go a little more aggressive and get a larger part of the pie in the international fund, meaning that it does have higher risk, but at the same time, it has higher return. And we'll be talking a little bit about that later. This is just a quick formula so that you can understand the importance of compound interest. Compound interest is basically when you have, say, $100 today, and we're doing this annually, not monthly. It's normally done monthly, but for the purpose of today, so that you guys understand, in a year you would get a 10% return, which is $10 of 100, meaning that you would have 110 after 1 year. So after 2 years, you have your 110. But instead of the interest going back to the original amount, the interest is over the amount that you have then, which is the 110. So 10% of 110 is $11, added up to 121. And we can see here in the formula, it then comes to 100 times 1.1 times 1.1. And say for 3 years, you could do it exponentially, where 3 years of $100, the 0.1 represents the percent, and then the 3 represents the amount of years. So n years would be the n here for the exponent. So say, for example, if you're going to do 7% of $100, you have 0.07, and then in 3 years you would have the exponent over here, or after you do the math, 122.50. So this was obviously done annually, so you can understand. But most mutual funds or any investments that you have are normally done monthly. So the compound interest is going to gain on a monthly basis. In other words, 12 times a year, and you'll get a higher return. We're going to be looking at a quick video just so that you can see the power of dollar cost averaging. And I already had it set up here.
Dollar cost averaging is a more conservative approach to investing than simply spending all your money on securities at once. This technique allows investors to commit to a fixed dollar amount of a particular investment on a regular schedule, regardless of the share price. More shares will be bought when prices are lower, and fewer shares will be bought when prices are higher, resulting in a lower average cost per share. Dollar cost averaging reduces risks by allowing investors to ease into the market over time. For example, Chris buys $200 worth of stock in Billy Bob's restaurants each month for 4 months. In January, the value of the shares drops to $50 each, so he buys 4. In February, the stock is worth $40, so Chris buys 5. In March and April, he buys 8 shares of Billy Bob's, which dropped in price to $25. Overall, Chris purchased 25 shares at an average price of $32. If he had invested all of his money at the same time, then he would have only bought 16 for an average price of $50 per share.
Okay, so we'll thank Investopedia for that little video. I don't know why the guy was in a wheelchair. That's kind of weird, but nonetheless, we'll continue. So, what I want to point out is that dollar cost averaging, if you already have the money, so say if you had $1 million because somebody died in your family, and your mother or your father, and then you had $1 million and you were going to invest all of it at once to gain immediate exposure, dollar cost averaging is separating it over a certain amount of times, so that way it fluctuates and you can buy more stocks when the stock is down and less stocks but a higher return when stocks are up. So it averages out to where you normally get a better deal. But there was a Vanguard study where lump sum investing, in other words, if you already have the money, lump sum investing and getting exposure immediately to the markets is actually better. But for monthly buyers like us, since we're not rich and we don't actually have the money, and we're usually investing a certain amount of money each month, it's better to go with dollar cost averaging instead of lump sum investing. Why? Because over, say, 30 years and everything, obviously you're not going to keep the money in your account and then, just spend a little bit to actually eventually get all your money out there. What you want to do is you want to invest everything that you can at the time that you have it so that you can get immediate exposure and hopefully get more returns that way. That's what I recommend anyway. So if you don't have any questions, that is it for me. I want to thank you all obviously for being here today. And like I said before, life cycle funds are definitely the way to go if you're planning on retiring and having money for that. Okay? Thank you.